I'm Randy Efron from Skylattice Property Capital, and in this episode, I'm going to explain what key money is with respect to hospitality real estate investments. Let's get started. Key money is a form of capital that a hotel franchisor or a hotel management company may provide to the owner of a hotel. Let me give you an example to show you where this form of capital would be inserted into the capital stack. Let's assume that a hotel costs $100 and that the owner obtains a loan for $65. That leaves $35 of required cash for the deal. Any capital that an owner receives from its franchisor and/or manager would reduce the amount of cash that the sponsor and its investors would have to fund into the deal. So in this example, if the total cash requirement for the deal is $35, and the franchisor or manager provides $2 of key money capital, the sponsor and its investors would only have to fund $33 rather than $35. Now you may be asking yourself, why would a hotel franchisor or manager provide capital to the owner of a hotel? The answer is pretty straightforward. Franchisors and managers increase their revenue by adding new hotels into their portfolio. Therefore, if a franchisor or manager sees a deal that they like, they are incentivized to help the hotel owner get the deal done so that they can add the hotel to their portfolio. If the hotel is successful, the amount of money that the franchisor or manager will receive from the hotel owner over time will far outweigh the amount of capital that they invest into the hotel. Additionally, since the corporate value of a hotel franchisor or management company is typically based upon an earnings multiple, the fee income that they receive from the new hotels that they invest in will result in a higher corporate valuation for their companies that will far exceed the amount of capital that they invest into a hotel. Key money is usually paid to the owner of the hotel around the time that the hotel starts generating revenue. This timing typically coincides with a certificate of occupancy for new developments or the completion of a renovation and/or rebranding for existing hotels that are already in operation. Sometimes the key money will be bifurcated into multiple payments, including one that occurs before the completion of construction. The terms of the key money are negotiable, but the amount that is provided to the owner of the hotel typically equals 5% or less of the amount of money that the hotel owner will pay to the franchisor or manager over the life of the franchise or management agreements. The key money can be structured as quasi-equity with no return or repayment characteristics. The key money amortizes over a predefined term that usually coincides with a portion of the franchise or management term. As long as the franchise or management agreement is not terminated during that period, the key money amortizes and the hotel owner does not have to pay it back. The key money can also be structured as subordinated debt, with or without interest payments. Another form of key money is deferred franchise or management fees. In this structure, the owner of the hotel does not have to pay the fees back to the franchisor or manager for a specified period of time. Aside from the general structural components that I just mentioned, some terms that may be negotiated include the following: performance thresholds that are tied to the repayment and/or forgiveness of the key money, the right to convert key money into equity, rights of first offers or refusals on the sale of the hotel, and the requirement to use the key money for certain brand-related expenditures. There you have it, an overview of key money. If you'd like to stay informed about new episodes, please click like, subscribe, or follow, or alternatively, send me an email at randy.efron@skylattice.com if you'd like to improve your capital raising process, would like to reduce the cost of your debt or equity, or you're looking for a finance-oriented CFO without incurring any overhead. Thanks, and I'll see you next time.